Hey, everybody out there with us today. We have two men of the hour to talk about finances in this world of uncertainty with where the stock market is from day to day, where the nation's economy and the global economy is going. People are more and more worried about what kind of investments they should make, where they should place their money, and to whom should they get advice. So with us, we have Alex Rogers, bottom of the screen with the Alex Rogers firm, a law firm in Wilkes-Barre, Pennsylvania. And he specializes in what we're talking about: stockbroker misconduct, investment and securities fraud, things like that, of that nature. And also another familiar face to my left, which is Mark Collinsworth of Vera Global Wealth Management, who is a financial manager. So he'll give us some more specific advice on what to look for when you're having somebody to manage your money. So why don't we start with Alex first? Alex, when people come to you, why do they come to you, and what kind of guidance and advice are they looking for?
Sure. Thank you, Larry. And it's good to be with both of you. If you think about the world of financial investing today, it's very different for consumers than it was, say, 30, 40 years ago. Mostly in the past, companies had pension programs, retirement programs. As consumers, we could simply rely on what the company was doing in terms of saving for our retirement.
Right.
These days, it's very much you're on your own. Whether it's in the form of an IRA account or a rollover that you've made from your employer. And the terminology can be very confusing. It sounds almost like a foreign language.
Right.
Uh, and so what's important today for consumers, we can't all become experts. I recall a headline in a recent national publication that said you needed a math PhD to understand annuities.
Yeah.
And that's just one type of investment. The most important thing is that you find someone that you can trust, someone that listens well, someone that understands your entire investment profile, and someone who takes the time to help educate you to a level where you can make an informed decision. You don't need to become an expert, but you need to know both the advantages and disadvantages, the pluses and minuses, the costs, the risks of whatever it is that you place your hard-earned money in.
Attorney Rogers, for those who don't know much about it at all, I mean, what are the red flags that you would tell them to look for? Because they know nothing about who to go to, what investments are, all of the minutia of it. So just the basic red flags, what to watch out for.
Sure. So one of the telltale signs is if you see significant swings in your account, up 1 month, down 1 month by significant margins. That suggests you're in what we call a highly volatile set of investments, or maybe one investment. It's important to look for diversification, so that if you think of a pie chart, you don't want all of your investments placed in just one slice of the pie. You want to see how it's allocated. Watch for the line that talks about account fees. It used to be that we would see a line for commissions where every transaction would generate a fee. Today, that's less the case. Now we oftentimes have accounts where we pay a fee as a percentage of what the total account value is. But there are still costs and there are still fees. Take a look at that line item in your account. If it's an investment that you can't obtain a real market value for, so we think of typical investments that are traded on the New York Stock Exchange. We see the ticker tape run on the bottom of the news channel, and we can see it in the business section of the paper. But there are many financial advisors out there, I don't think Mark is one of them to be sure, that sell products that don't get traded in public markets. They're not what we would call readily liquid. If those are in your account, you need to ask questions about why and what the risks are, because the risks oftentimes for private investments are much higher than they are for publicly traded investments.
Okay, so Mark, what do you think of all that, what's been said already?
Oh, well, thank you, Larry. And I totally agree with what Alex said. That is a great piece of advice. If a security's in your portfolio and it's illiquid, you probably don't need to be in it. And you need to ask why it's in the portfolio. And more importantly, ask the advisor, did he get paid a commission on putting that product in your portfolio? I see clients so many times want to just chase returns. If you want to make money long term in the stock market or investment markets, do what Warren Buffett has done. Invest in high quality stocks. You know, he owns J.P. Morgan, Exxon. Invest in those companies. At the very least, you'll at least sleep better at night when the market does get in trouble.
Well, Mark, a lot of people don't realize how the fees work. I mean, when there's a trade, a buy or a sell, the broker gets a fee, right? Isn't that normal procedure?
Well, in our industry, there's two. There's brokers and there's advisors. So brokers get paid on commissions. So if you go out and let's say buy an annuity or you do one of those private equity investments or illiquid, they get paid an upfront fee. So once they get paid that upfront fee, they really don't care if you make money off. They've already been paid. Whereas on my side of the industry, I get paid a fee to constantly watch and monitor your portfolio. So the more money you make, the more fees I collect. So I have an actual interest to make you money after I get you into a product.
And every time you buy or sell, do you collect a fee?
I do not collect. That's the thing with financial advisors. They do not collect any fees on the buying and selling. They actually make a fee on the portfolio as a whole. So if the portfolio grows in value, their fees grow in value. And of course, if their portfolio goes down in value, those same fees decline. So it gives me an invested interest to actually see you make money.
Now, Mark, you've mentioned before about how you check out somebody ahead of time, how you check out a broker or whatever. I mean, there's ways to go to the internet for people and find out what the history is, what the history of violations are, citations, etc. So both of you could jump in any time to explain that.
Well, I'm going to recommend Broker Check. It's run by FINRA. It keeps a list of all the problems that are punishments that are deficiencies that an advisor or a broker has actually been involved with. So you can actually see if you see like illiquid securities in your portfolio and you go to Broker Check and you see he has a history of getting in trouble by buying illiquid securities in clients' portfolios, that could be a major red flag for you.
Alex.
Yeah, Mark's exactly right. Look, most financial advisors have never had a customer complaint. They play by the rules. They do their job. They're highly skilled professionals. But there is a small category of financial advisors who can't resist the financial temptation to place their interests ahead of their clients. And their interests are specifically what Mark said is commissions. I would be wary as a customer to one of the key marketing tactics that some advisors conduct are free dinner seminars. They'll invite you to the local fancy steak place. They'll wine and dine you. They'll have fancy posters up that will show you about special investments that you've never heard of. And I can tell you that more often than not, you have indigestion after that dinner because you've been invested in a bad financial product. Be careful about those get-rich-quick pitches or the pitches that say, and Mark raised a good point a few minutes ago, the pitches that say, don't risk your money in the stock market. In this other area, it's better. And as Mark alluded to, if you have been invested in the stock market in a broadly diversified portfolio or a low-cost index fund over several years, even if there are down years, over several years, you will have made money based upon the historical performance. If you need that money in the next year or two, you don't want to be in the stock market. You don't want to be in the other investments. But if you have a longer term horizon, it almost sounds counterintuitive, but your money is better off in publicly traded stock market than it is in private investments that offer you quick returns in the short term.
Okay, but Alex, what I would say, and I think what many of our viewers might be wondering, especially those that are not sophisticated about this, is does that rule still apply that over the long term in a diversified portfolio, the stock market is still largely the best bet? Now, with all these swings, all these international situations, nothing seems as stable as it once was, including the stock market. Or am I wrong about that?
No, I think you're absolutely right. And I was alluding to a time period of 5 or longer years. If you don't anticipate needing the money for at least 5 years, the historical performance of the stock market suggests that the value of your assets will increase. particularly if you reinvest the dividends rather than take them out.
Mark, what do you think, Mark? Is Alex right?
Oh, I totally agree. Give you an interesting study they did one time. If you'd actually invested in the stock market on the 4 worst days of the stock market in the last 100 years, that's if you invested in the day before the market crashed in 1929, you invested the day before the 1987 stock market crash, you invested the day before the housing bubble popped, your money still ended up growing somewhere around 11 to 12% over that time period. That's a great return, and that's investing on the worst possible times in history. So I agree with Alex. Buy high quality stuff. Don't chase stocks, and please don't invest in a stock because it's gone up 200% in the past 12 months, and you want to buy it and have no clue to what they make or what they do or where they're making money.
And what are the stable, sure thing or surer thing investments? I mean, they say things that products that people always need, Procter and Gamble, toiletries, hand towels, et cetera, et cetera. That's pointed out often as a good example. What other things? I mean, what makes a stock kind of a sure thing because it's something that people always need, recession or no recession? Anybody?
Well, there's no such thing as a sure thing, even in investing, but there are certain things that you can look for that dramatically will increase the odds of you making money in a stock. Look for companies that have high free cash flow. That's money that's left over after they've reinvested money into the company. It's basically their extra spending money. Look for companies that have those high profits. Look for companies that have high returns on invested capital. That's where they take that leftover profit and they reinvest it into new marketing tactics or new products, or they try to innovate. Look for those basic things, and the same companies. That's what Buffett looks at. Those are high quality blue chip companies, and if the company pays a dividend, that's just icing on the cake for you.
Alex?
No, I think that's exactly right. And the temptation, we'll talk to our neighbor, we'll see someone at the grocery store and they made a bet on a particular company and they've done well, and we tend to want to chase that, or we get what I call neighbor envy. Everyone is different, and it's a multi-factored analysis. You need to think about what Mark said. If you can sleep at night, you need to think about your risk tolerance. If you're uncomfortable on a roller coaster, even a gentle roller coaster, stock market's not the place for you. If you're going to need your money soon, if you anticipate expenses coming up, maybe you want to help a child or a grandchild with college education. If you think you're going to need the money in the short term, then that portion of your nest egg should not be invested even in the best stocks. But what I want to talk about a little bit too, Larry, is this sense that people might feel like they're all out there on their own. And it is an intimidating world. As I said, the terminology seems to be very difficult to wrap our hands around if that hasn't been our profession. If you sense something's wrong, even if you can't put your finger on it, but you just feel in your gut, I'm uncomfortable, there's something, it just doesn't seem right. There are lawyers like myself and others around the country that specialize in advising consumers and evaluating their portfolio and determining whether or not the financial advisor has violated one or more rules or regulations that govern the relationship between an advisor and a consumer. And that's a very important resource for people to know that's out there, that they can seek help and guidance from a lawyer to determine whether or not what happened in the account is suitable and appropriate for them.
And how do you find a good lawyer?
Well, there are specialists in this field. We all certainly have websites, and there are bar associations. And hopefully in each person's community, they can ask for recommendations or referrals. Like a lot of areas of the law, it's a complex subject. Hire a specialist. If you practice in a different area of the law, you can't fake it as a lawyer for a victim of stockbroker malfeasance. So look for someone who does this day in and day out, and can help guide you on the potential avenues for remedy, because there are remedies. If you find that there have been products sold to you, either false representations, what we call fraud, where you were intentionally misled, or even if an advisor's been negligent, meaning he or she hasn't acted with the reasonable care appropriate for someone in that position of authority, the law provides an opportunity for you to seek a remedy and obtain financial relief against that financial advisor and maybe his or her financial firm as well.
Mark?
I would totally agree with that. I think the best way to sum up, if it sounds too good to be true, 99% of the time, it really is just too good to be true.
Well, let me ask you this, has the proportion, the number of snake oil salesmen increased in recent years because more people are trying to get into the stock market, into different investments, or has it been pretty much the same all along? But are there more the con artists out there than ever before?
Well, we certainly hear about the infamous cases, the Bernie Madoff type cases. The sad truth is that in communities and cities across the country, there are problems. I'm not sure if it's more today than before, but what I said a few moments ago is directly on point to what you're saying, Larry. We used to have companies handling the retirement accounts. Now, a lot of us are on our own. That means we're probably better prey for the unscrupulous financial advisors out there who take advantage of the imbalance in the knowledge. And we also see today an increasing proclivity of what I'm going to call sort of new products. Just as Mark was discussing before, these private investments, different types of annuities. I have a case now for a couple that's struggling to learn what it means to have something called a universal life insurance policy. We all know what life insurance is. We buy a policy that in the event of our death, our beneficiaries would receive the death benefit to help meet their living expenses. But that's not what this is. This is a much more intricate, complex product. It costs more. Not surprisingly, it often pays a higher commission to the salesperson. But if someone tries to sell you a product that sounds more complicated than it needs to be, ask the hard questions, wait, hesitate, think twice about it.
All the rage for a while has been Bitcoins, cyber currency, and some people have made a lot of money on that. Still something to totally stay away from, or can you delve into it if you know what you're doing? Either one of you, what do you think? Mark?
That's one that puzzles me about Bitcoin. It has no value. I mean, it's just air. Think about it. It has the only reason people buy it is because it went up 30 or 40% the previous year and everyone keeps talking about it. I mean, there's nothing there to it. I mean, it would only take I go back to the 1930s when people were buying gold instead of putting money in the bank. The Federal Reserve made gold illegal. That's how we got and confiscated it. That's how we got gold in Fort Knox. If we get into another economic catastrophe like 2008 or COVID or something, and the Fed prints money and people start putting that, let's say, in a digital currency, if I was the Federal Reserve, I would just simply make digital currencies illegal to own the United States to force people to put money back in the economy. I mean, I can name numerous reasons on why Bitcoin is not an investment; it's speculation.
But
I think also just on that point, it's also important to realize that the legal framework surrounding the Bitcoin markets is woefully deficient compared to the regulatory framework for normal New York Stock Exchange over-the-counter stocks. By that, I mean we have in the United States the Securities and Exchange Commission, the SEC. We have a self-regulatory organization called FINRA, the Financial Industry Regulatory Authority. So we have regulators and a system in place with a legal structure to govern the investments you make in our securities markets. Contrast that with the fledgling Bitcoin market, where the regulatory framework is much, much weaker, if existent at all.
Well, how about this? If you really know what you're doing, and if you know when to get in and when to dump out of it, you can make a lot of money, correct? Or mythology?
That's correct. But if you're that good at it, my recommendation would be for that person to go start a hedge fund and start investing other people's money.
You think,
Timing in the market is a perilous thing. Let me give you just one quick example of that. I represented a client who was encouraged to invest in options. So an option is a contract that enables you to either buy or sell in the future, as opposed to a stock where you're actually buying the stock. So if you buy or sell an option, it's a contract to make a transaction in the future at a certain price. Well, let me tell you something a lot of people aren't told. Options contracts expire on a date certain, oftentimes at 5:30 in the afternoon. The publicly traded markets end, as we know, at 4 o'clock. If you're not at your desktop or your computer between the hours of the market closing at 4 and the option expiring at 5:30, you could be in for a very significant financial loss and not even know about it. So it's those intricacies. It's a full-time job. If you want to time the market and you want to be an investor, yes. Are there success stories out there? There sure are. But there are also, for every success story, there are plenty of very, very painful, sad stories about people who have lost money in the market thinking that they could time it.
all right, this is a good time to bring up this point, which still mystifies me. People like Madoff, Sam Bankman-Fried, they swindled so many people out of enormous sums of money. People who had money, people who were celebrities, people who knew other people that seemed to know what they're, I mean, how did they so easily become victims? I mean, is it just that we assume because a person is famous and knows other celebrities that they'd automatically be sophisticated about this? And that's not the case at all. They're just babes in the woods. What do you think, guys? Mark?
Well, it really comes down to, from my experience, people that are criminals that's what they do. They spend all their time trying to figure out ways of how to swindle people out of money. They're very good at marketing, and I think that goes back to what I said earlier. If it sounds too good to be true, it probably is. And if you just ask some basic questions, and if you can't get the answers that really truly get to the heart of your question, you probably should just walk away from it. And I've done that multiple times, and look back 2 or 3 years later and I'm really glad I didn't put money in that investment. So it's simplicity.
Alex, how are sophisticated, college-educated people, high society people so easily duped?
Well, that's a very good question, and I think we'd all need a PhD in psychology to appropriately answer that. But I can tell you that what happens is oftentimes fraudsters build an aura around themselves. They drive the fancy cars. Their offices are gilded with gold. They have the overstuffed leather chairs in the reception area. They give outward appearance of being highly successful. But as we know from the famous adage, you can't always tell a book by its cover. Mark is absolutely right. Don't get caught up in the bells and whistles. Ask the hard questions and probe a little bit. But the Madoff experience, you're absolutely right, Larry. What makes that particularly jarring is that there were sophisticated financial advisors to nonprofits, to foundations, to other entities that were convinced that was a sound place to put their money, and they saw account statements and they saw returns. So I don't want to say that it's easy to identify a fraudster. And that one, as I said, was particularly jarring because of the highly skilled professionals in the industry that were duped. And it is an ongoing problem, and that's why we do have enforcement mechanisms in place. The more transparency, the better. if your account statements keep going up and up, ask yourself a question. Are they really actually account statements, or have they been doctored? It pays to be skeptical in this field.
All right, closing comments now. We're going into an election, and there's all kinds of analysis, all kinds of speculation, all kinds of worries about where the economy will be after the election in November, depending on who gets into office, what happens domestically, internationally. So what is an investor to do? Park his money in cash, keep investing going into November, and thinking beyond November from where we are now, trying to look into the future. What's the best simple advice? We'll start with Mark.
I think it just comes down to simply being, for the retail investor, for the non-sophisticated investor, diversification is probably their best tool. Put some of those blue chip stocks in your portfolios that have dividends. Put your money in some five-star money manager mutual funds that Morningstar recommends. Put your money in a little bit in bonds. The 60-40 split on bonds and stocks, that strategy is not dead. It's proven itself year after year. Hasn't proven itself in the last 2 years, but diversification, it really does pay off if you don't know what you're doing.
Alex?
Yeah, I think that's exactly right. And it's easy for all of us to get tripped up in the current events and to try to outsmart the markets in terms of how a specific event might affect the nest egg that we spent our lives building. My suggestion, and I've said this to my children as they've reached adult years, is if you think about a yo-yo, that yo-yo is going to go up and down as you're playing a yo-yo. But if you're playing with that yo-yo and you're on an up escalator, eventually you're going to get to the next higher floor. There are going to be times when your yo-yo's down, times when your yo-yo's up, but you're going to get there. But if you're invested in the markets, you need to have a time horizon that's longer than the next election, longer than the next oil crisis, longer than the next international conflict, because there will be moments in time that we can't predict and that we can't time that will have a damaging effect on our investments. But just as Mark said, if you invested on the worst days of the market, if you hold on tight, if you don't panic sell, and you survive through that downswing and watch the markets come back, in the long run, you'll be doing very well. But once we start that game of trying to guess which candidate's going to be better for our portfolio or when an international conflict is going to resolve itself, we'll drive ourselves crazy, and most often we'll be wrong.
Well, gentlemen, thank you very much for some very timely advice in these uncertain times, and we'll be continuing this as these uncertain times continue. So Alex Rogers of Alex Law out of Wilkes-Barre, Pennsylvania, and Mark Collinsworth of Very Global Financial Wealth Management. Thanks, guys, for being with us. To be continued.
Thank you.
Thank you, Larry.